With P3, we are specifically focusing on an example. So we've looked at marginal costing and absorption costing and where it fits in. We've looked at the requirements and we're saying to ourselves, okay, let's do a practical example to actually see how this applies.
Absolutely.
And Shafisa, over to you.
Thank you. Thank you for having me, and we'll be looking at P3 question, because when you look at the assignment, you have to attempt a practical question where you have to solve a practical problem and coming to the conclusion saying that should you go ahead with this project or not. If you look at this illustration, which is illustration number 3, and it says if there is closing inventory in place, how are we going to produce an income statement using marginal costing and income statement using absorption costing, how the profit's going to be different, and if there is a difference in the profit, what is the reason behind that difference. So looking at the question, we said the example we used in the last class, we said that we're looking into the same question, but the only difference is that there is a closing inventory of 2,000 units. It means we haven't sold everything we have produced. So we have produced 10,000,
yes,
but we are just selling 8,000, and the 2,000 we will be taking it over to the next year.
Yes.
And that is where the closing stock comes in place. And it says that because we are looking at only 8,000 units to be sold,
yes,
we have to divide the selling overheads, the variable selling overheads,
yes,
between these 8,000 sold and the 2,000 unsold.
Yes.
Because they are variable, it means they varies with the sale.
Yes.
So if you are not selling something, you shouldn't be taking that cost into consideration. So for those 2,000 units we didn't sell, we have to take that cost out from the total variable selling overheads. So if the total variable selling overheads was $187,500, that's for 10,000, we have to calculate it for 8,000, and clearly it says that for 8,000 units, it's $150,000.
Because it was a closing inventory of 2,000.
Yes. So we are not selling it.
Yes.
We have to take the cost out for what we are not selling it.
Right.
So the difference between these two, will be taking it to next year.
Okay.
Yes. So moving forward, what we did yesterday and clearly showing that as well, we said when we look at marginal costing, and in marginal costing we just concentrate on the variable cost, and we said the 3 variable costs that relates to manufacturing are direct material, direct labor, and the variable manufacturing overheads. And if we add them together, it gives us the product cost,
yes,
which are related to the manufacturing of the product. But to understand that, we said this is the product cost for 10,000 units,
yes,
that we have produced.
Yes.
But again, because we have just sold 8,000 units, we have to clearly calculate out of this how much is for 8,000 units,
yes,
and how much is for 2,000 units.
Yes.
And for doing that, you divide this by 10,000,
yes,
you multiply the answer with 8,000, and you get the price for 8,000.
Okay, so you take the 840,000, you
Yes.
times it by 8,000,
Yes, and
which
you
is the units that's been sold.
Yes.
And then you divide by the 10,000.
Yes, because that is for total 10,000.
And then the number that is left, you take the total product cost,
Yes.
times by the 2,000 units,
Which
and
is
then
the closing
divide
stock,
by
yes.
the total amount, which is 10,000 units, which gives you that cost. And
Absolutely.
presumably, if you add both those two together, it gives you 840,000.
Absolutely, that makes sense. So this is what we have to take in our income statement as a cost of goods sold when we are moving forward, because we are just looking at the amount which we have sold, right? So if we come to the statement now, and this is the statement, it's clearly showing, it says we have sold 8,000 units. The selling price was 200 per unit.
Yes.
So that's our sales.
Yeah.
We have just calculated the variable cost of sales for 8,000 units.
Yes.
And this is what we have calculated.
Yes.
If we take this out, the sales minus variable cost, it gives you the contribution, the term we learned yesterday, as a difference between the variable cost and the selling cost. Then we got selling overheads as well, the one we calculated because we have just sold 8,000 units.
Yes, and this would be on the administration charges, I presume.
Yes, they are the selling and admin.
Yes.
So that comes out, it gives you the final contribution. You take out your fixed overheads out to give you a net profit. Yesterday we did the same thing with a different method, and I'm going to do the same with a different method to make it more understandable.
Okay.
So if I quickly go through that on my board, it says sales, and if you look at sales, it's your this one. So that's your sales figure. If we take out cost of sales, which we are looking for only 8,000 units because we have sold 8,000 units. So you sold 8,000, you look at the cost of 8,000. And if you go back to the previous slide, we have already calculated it and we said it's 672,000. You take it out and you come to your contribution, and this is contribution. After contribution, we have to take out all the fixed and non-manufacturing. So you can do the way they have done it, or you can combine them as well. And you said what I'm going to take out from here is anything which is non-manufacturing, so not related to manufacture, and which is fixed in nature as well. So these are the two costs we are looking into. So we're looking at fixed manufacturing because they are fixed. We are looking at fixed selling and admin because that is fixed, and we are also looking at variable selling because that's non-manufacturing. So we combined all these three, we take it out, and the remaining will be your net profit. So we'll be looking at 150,000 as variable selling, we're looking at 300,000 as fixed manufacturing, and we are also looking at 250 as selling. And when we combine them all together, it's 3, 4, 5, and it's 600,000. We take it out, and it gives you a profit of.
So that, in essence, is your net profit.
Yes. Net profit. And that's what I said yesterday, that the difference between the marginal and absorption costing, that you don't have a gross profit here. In absorption we got gross profit, but in marginal we got a contribution. And we got a contribution here because this is only the variable element and not the fixed element.
So from my understanding, correct me if I'm wrong, the difference between marginal and absorption costing in terms of the cost of goods sold will be that in the marginal costing there is only variable costs in the cost of goods sold, whereas in absorption costing there's there's fixed and variable costs in the cost of goods sold, which leads on to your gross profit, and in direct comparison to marginal costing, which is a contribution base.
Absolutely. And that's a very good level of way of explaining it, because now when you're gonna make the same statement and absorption costing, you will realize that the answer is different for the profit. And like you just said, that because the difference is between when we're looking at the fixed manufacturing overheads. So here we have taken it as a period cost, and all of them has gone out. But when we'll be looking at absorption costing, we will realize that we are just taking this for 8,000 units, not for 10,000 units, and the remaining 2,000 units makes the difference. So that's the same thing.
That's really good, and you've made it absolutely clear. So I presume we're going to see an example now of absorption cost.
Absolutely, that's what we're going to look at. So when we look at absorption costing, we do the same thing what we did before we started the income statement and the marginal costing. We added the cost, which is as a product cost. The first three figures, so first direct material, direct labor, and variable manufacturing overheads are same. The final figure we add here is the fixed manufacturing overhead, which is a product cost under absorption costing. You total that up, and again you divide this cost under 8,000 units and 2,000 units. Doing the same thing, we got 912,000 here and 228,000 here. This is your closing stock. This is your cost of goods sold for 8,000, but it got the element of fixed manufacturing overhead, and that is the basic difference. So if we look at the statement now, we are looking at this. Again, sales figure is same.
Yes.
Cost of goods sold, we have just calculated with the 4 elements as product cost. You take 2 out, it gives you a gross profit. You take out your variable selling overheads for 8,000, which we calculated as 150,
yes.
and your fixed selling and admin overhead, which is 250.
Yes.
These both are non-manufacturing, and that's why it's after gross profit.
Yes.
And the final figure is your net profit.
So there's a higher figure,
yes.
in absorption costing,
absolutely,
in comparison to marginal costing.
Yes.
And why specifically is that?
That is where people has to reconcile the two statements to understand that there is a difference and why there is a difference. And for doing that, we use this, the reconciliation of two profits. So what we have done here is we said the profit under absorption costing is higher,
yes.
than the profit under the marginal costing.
Yes.
And we clearly can see that the difference is coming from, for the 2,000 units we didn't sell.
Yes.
And the only figure that affects that 2,000 is the fixed manufacturing overhead portion of the 2,000 units. So if we go back to the original question, it says the total fixed manufacturing overheads for 10,000 units was $300,000. If that is for 10,000 units, how much is for 2,000 units? So you divide it by 10,000 times it 2,000, it tells you that for 2,000 it's 60,000.
Where did you get the 300,000?
It is in the question, because if we go back to the question where we started it, it says fixed manufacturing overheads 300,000.
Right.
We have treated this as a product cost under absorption costing,
yes.
whereas we have treated it as a period cost in marginal costing.
Yes.
Clearly understanding that thing, what we are trying to say here is, in absorption costing, we have divided the fixed manufacturing overheads into the sold units and the retained units, so closing stock and the sales. Whereas under marginal costing, we are not bothered about have we sold everything or not, but if that is expense, you just take out the expense. So that's how we understand that
The difference is going to be in the products which are not sold.
Absolutely. So which is left behind for next year to take over as a sales.
Yes.
So that's your closing stock.
Yes.
Because the stock is lying there.
Yes.
The cost of that stock includes the element of fixed manufacturing overheads in them under absorption costing. So if you calculate cost of closing stock under marginal costing, you are just looking at the variable cost. When you're looking at closing stock under absorption costing, you're looking at the variable cost plus the element of fixed manufacturing overheads in them, and that is why there is difference between the profits. And this is what we have just seen here, that the two differences are arised because of only one figure, which is your fixed manufacturing overheads and in the closing stock.
Yes.
And
So
it clearly
how do we reconcile this then?
That's the only thing, because we have to only find this figure.
Yeah.
And we said this is the higher profit. You take out the fixed manufacturing overhead portion of closing stock, which is 2,000 units, and it gives you the profit under marginal costing.
Okay.
And that's the reconciliation.
And that's the reconciliation.
Yes.
Okay, so it still comes to the same anyway.
Absolutely. We are just telling them why there is a difference. So reconciliation is basically finding and analyzing the difference, that why there is a difference, where that difference has come from.
Yes. So really, if we look at the contribution figure,
Yes.
for that's for
Marginal costing. Yes, that's marginal costing.
we can see that the contribution figure is going to be higher, less than
it's going to be higher than
the absorption cost.
the gross profit.
Gross profit.
So the gross profit, if you see, is 688,000.
Yes.
Whereas the contribution is 928.
Yes.
Because we have already taken